Hello. I just want to thank you for taking the time to tune into this recording. This webinar is entitled the Debt Freedom Webinar. Very powerful information included in this webinar. I was very excited to create this webinar and this presentation because I understand how it can really impact people's lives. Whether you are a current homeowner or you are a future, an aspiring homeowner, this information is useful for you. I want you to understand that coming into this webinar, you are not, I really want you to take this seriously. I want you to take notes. I want you to envision your life and how this might be a possibility for you using the information in this webinar to free yourself from the chains and the shackles of debt that you are carrying right now, to be able to put some more money back into your pockets every single month, and potentially even give you a lump sum of cash that you can use to invest, or improve your quality of life. This is a very powerful webinar. Like I said, let's jump straight into it. Okay. Let me quickly share my screen. All right, let's get in. Let's jump into it. So, like I said, this is Genus Mortgages, my business name as a mortgage broker. That is my brand, Genus Mortgages. This is the Debt Freedom Webinar. And the headline or the tagline that I like to use for this webinar is your home's equity can change your financial future. And this is why I was talking about whether you're a current homeowner or you're a future homeowner, this can really impact impact your financial future. If you're a current homeowner, it can impact it, because you've owned your home for a certain amount of time, so you have some equity built up in your home. If you're a future or aspiring homeowner, this can still very much impact you. This information can be valuable to you because if you have this knowledge, it can actually dictate and steer you in the right direction in terms of making the purchase of your first property, right? I will get a little bit more into detail with regards to how it can really impact future homeowners. So let's start off with the introduction. Excuse me. So welcome and thank you for joining. Who am I? So my name is Omar Genus. I'm a licensed mortgage agent at the level 1 in the province of Ontario. I've been a mortgage agent for about 1 year now. Today is July 2nd, 2025. And so I got my license, I think it was close to April or so last year. However, I actually really ramped up and started business activity in the month of July. So I like to call July my year beginning, I guess. So yeah, I've been in the business for about 1 year. I've been in the business for 1 year, sorry, but I've been involved in real estate activity for about 5 or 6 years now. And so I carry a lot of knowledge. The reason why I got into mortgage brokering, it was essentially to help people like I was, 6 years ago when I first purchased my first property. I felt like a lost puppy. I felt like I was doing research on the fly and trying to keep up with the mortgage agent. And, you're putting your hands of your largest investment, you're spending all of this money. All of this money is leaving your account, right? And you want to make sure that you're working with a professional that's on their P's and Q's and knows what they're doing. And so, not to say that I had any like horrible experience or nightmare experiences. However, I did want to be able to control, my situation and put my best foot forward for the lenders. And so I was putting that, my trust in other professionals to do that for me and hoping and trusting and believing that they are well equipped to do so. So I got involved in this because I've been through 2 transactions myself personally, and they've been okay processes. But I understand how, kind of being ghosted or not being communicated with for maybe, days or even weeks sometimes can be very stressful. So I really aim to kind of give my clients clarity, and education and knowledge so they feel comfortable throughout the process of purchasing their home. So that's the reason why I got into it. So yes, like I said, I've been involved in mortgage brokering, particularly for a year. I am a finance geek and nerd. If you do follow me on social media, you'll see that I post a lot about the Canadian economy. This year has been crazy with tariffs between the US and talking about trade talks and renegotiating trade agreements and stuff. It's been a lot of back and forth. I talk about interest rates, why they're going up, why they might come down. I talk about a lot of that stuff. So if you're super interested in hearing about that and learning about a little bit deeper about why interest rates are impact, what impacts interest rates, apologies, and why they go up and down, and when the interest rates go up and down, what does that do to the Canadian economy in a whole? So I talk about a lot of that on my social media and also my LinkedIn. Um, so what you'll learn today, we're going to dive into what exactly mortgage refinancing is. I'm sure a lot of you have probably heard about mortgage refinancing. It's a pretty popular term in our day and age. It's a very popular tool that people use within the real estate industry to be able to cash out on some big cash to be able to do some things that they're hoping to do. And so it's really important to know what exactly it is. When does it make sense to refinance your mortgage? Just because refinancing your mortgage is a positive thing for another person might not mean that it's a positive thing for you, or maybe the way and the structure and how you approach it might not be beneficial for you. So it's really important to know when it makes sense for you. What are the pros and the cons of refinancing? So that there's always negatives whenever there's positives, right? There's always an opposite reaction, and so to every action. And so it's really important to understand that there are some downfalls that could be possible with a refinance transaction if you don't approach it with the right lens or with the right strategy, right? So that's really important to know. And how to know when it's the right move for you. That's really important because you can know, what a refinance is. You can know when it would make the best sense for you. You can know all the pros and cons, the pitfalls, the disadvantages for you. But you also have to know your current financial situation and why it would fit within your financial plan going forward, right? That's one of the most important things that I like to talk about. So we're going to jump into it now. What is mortgage refinancing? So refinancing your mortgage, essentially at the root of it, is just replacing your current existing mortgage on your home with a brand new one. That's the bare bones definition of what a mortgage refinance is. Now it comes with a lot of different implications, a lot of different factors, a lot of different terms and stuff like that that are a bit more complicated, and we'll dive into that a little bit. But at the bare bones of it, refinancing is essentially getting rid of your existing mortgage and getting a new one. It can be with the same lender or a different lender, right? And this is definitely something to think about if you are considering refinancing your home, because if you're deciding to stick with the same exact lender, you want to make sure that you're getting the best terms, right? If you're shopping the deal at a different lender because you have your current one with TD and you're going to Scotiabank may be willing to give you better terms to gain your business from TD, right? So it's really important to understand and work with a mortgage broker who can really help you in this regard and represent you well with the knowledge that they have of the products that are available, the interest rates that are available at different lenders, right? And different, the mortgage broker can really kind of position things for you well. Common reasons for finance. So let's dig into this. So the reason why someone would want to refinance their mortgage is to get a lower interest rate. A lot of people are in this predicament where they purchased their property in 2022, 2023, when interest rates were at their peak. A lot of people had 6 or even 7% interest rate. So getting down now where interest rates are at about 4.5%, even under 4% for some people, depending on the deal and what the lender is willing to offer you. I've seen some people getting under the 4% mark. And so lowering the interest rate would definitely be a reason to refinance the mortgage. Accessing home equity, right? If there's equity that has been built in, that has grown, into your home, your home is appreciated in value based on market conditions, based on, forced appreciation, what have you. That would be a reason to refinance your property to be able to withdraw and have access to the appreciation in your home. Right. And just to kind of give you a quick definition of equity in case you might not know, the equity in your home, you can think of it this way. Whatever the market value of your property is and what it would be appraised for, minus your mortgage balance, that that is going to be the difference of that is going to be your home's equity, how much equity you have in the property. So for easy math, let's say your home is appraised and the market value of your home is at $500,000, right? If your home is worth $500,000 and you have a mortgage of about $300,000, that means the 500,000 minus the mortgage balance of 300,000, you're left with $200,000. So your home's equity is you have equity in your home of $200,000, right? That's how home equity works. The third reason, common reason, and this is definitely not an exhaustive list, by the way, but the third reason for refinancing your mortgage would be to consolidate your debt. This is a brilliant move, and we're going to dive into this in depth a bit later in this presentation, particularly talking about debt freedom. But a lot of people benefit from consolidating their debt into their mortgage so that they're able to free up a lot of money for themselves every single month and can potentially have the opportunity at a large lump sum of cash to be able to, now, increase the quality of their life. And lastly, changing the mortgage terms. You're in a mortgage where maybe you didn't work with a mortgage agent or broker that is well versed and had really good client service, and they didn't really educate you and teach you and look at your life scenario and put you in the best scenario for your mortgage. And so now you're looking to simply just change your mortgage terms to better terms because life has changed, right? Life has changed. Life changes for everyone. You get married, you have children, your life changes. Sadly, some people, they're married for 10, 20 years and then they get divorced. Life changes. So it's really important to understand, what kind of things. Of course, there are some things in life that are unforeseen, but there are some things that can be anticipated based on the trajectory and the plan of your life and where you're headed and what you want for your life. So you can kind of, as best as possible, control your mortgage with getting the right terms for where you see your life going. Let's go to the next slide. So we'll talk about the benefits of refinancing. So why is it beneficial to refinance your mortgage? Number one, because you can get access to lower interest rates. So whenever your interest rate lowers on your mortgage, you're actually able to reduce your monthly payment because you're going to be paying less interest on the mortgage, right? And so that is a very powerful way to save some money in the long term. And even the short term, right? Like you can definitely shave off a couple $100s. I've seen some people that had their mortgage at about 6 or 7%, and now they're maybe at under 4% or around the 4% mark. They're shaving off a couple $100s every single month off of their mortgage, which is pretty powerful, right? Like if that can be money that you can put saving for your children, or a spending account. That can be some really good money that you can use to improve your quality of life. Again, accessing the home equity. So borrowing against your home's value. So you're essentially increasing your mortgage to be able to get access to that equity in your property. And we'll dive into this a little bit more. I don't want to get too deep into it now because I don't want to confuse anyone. But basically, you're able to access the cash, the appreciation in your home. Debt consolidation. So we'll dive into this a little bit later too. So combining higher interest debts, right? So you're taking your credit cards, you're taking car loans, you're taking student loans, personal loans, line of credit. You're taking all those forms of debt with high interest rates, right? 20%, 10%, 8%, even 6% for car loans. Nowadays, if you got really good credit, that's like a rate that you're probably going to get, maybe even a little bit more with good credit. If you get, if the dealership really gets you and you don't have any good negotiation skills, but you're essentially taking all that debt and putting it into a mortgage, right? And again, we'll dive into this later. But you can greatly save yourself on monthly payments every single month. That can be very, very powerful for you. And we'll talk about this again, or sorry, switching your mortgage type. So talking about that. So, excuse me, if you wanted to switch from a fixed mortgage to a variable rate mortgage, we're seeing a lot of people that during the pandemic fixed their mortgages, because I personally did it myself, just because in the market, nobody knew how far the Bank of Canada was going to raise interest rates, right? So my wife and I's first property, we had a variable rate mortgage because those are always the lowest at that time, right? Before the pandemic. And then of course, the pandemic rolls around, inflation is kind of going crazy. So the Bank of Canada deemed it necessary to raise interest rates up to, I think it was about 5.25%. And so a lot of people were at the 6% mark, 7% mark, some even 8% mark. So it was really, really scary for a lot of people because your budget is kind of getting blown for the month, and you have to do some damage control, and so you're fixing your mortgage, right? So if you fix your mortgage and you're in a scenario now where you want to take advantage of variable rates that are dropping, you'd have to refinance your mortgage. So break your current mortgage, get rid of that existing one, and get a new one with different terms and a different type, right? Um, Now I'll talk about this while I'm on the topic. Breaking a fixed rate mortgage. So anytime you're breaking the mortgage, that means you're refinancing, you're selling it, or anything like that. So breaking a fixed rate mortgage is much more expensive than breaking a variable rate mortgage, right? Every lender is going to give you penalty for breaking the mortgage, right? Because they're expected to make a certain profit off you, at least for that 5-year term or 3-year term or what have you. And so if you're breaking the mortgage, that's a term they put in there to protect themselves so that they get at least a little bit of compensation for you breaking the mortgage, right? So on a fixed rate mortgage, you're going to pay a lot heftier penalties than if you're going to pay a penalty for a variable rate mortgage, breaking that type of mortgage. Variable rate mortgage penalties are typically around 3 months worth of interest. So I'll give you an example. My wife and I, we refinanced our first property, and I believe the penalty that we paid at that time was about, I think, about $1,100 or so, about $1,000, 1,100, around that mark. So it was not very expensive at all to break that mortgage. I have clients right now who are in fixed rate mortgages and are kind of curious to see what it would look like. And a lot of them are seeing numbers in the tens of thousands, even $15,000 to break their fixed rate mortgage. So it's a lot more expensive to break a fixed rate mortgage. And again, it's because the bank is not able to kind of get the total compensation they would get from you as the borrower. So that's what they fix in your term of their mortgage to protect themselves and still at least make a little bit of a profit. The last thing would be to shorten the term of your loan, right? So shortening the term of your loan would actually allow you to be able to pay off your mortgage faster. Now, why is that? The average mortgage is amortized at about 25 years, right? Some now, if you're a new borrower and you're purchasing a new build, for 30 years, right? We know that Canada made those changes to the mortgage industry very recently. And so if you are looking to pay off your mortgage faster, it would make sense for you to decrease the length of amortization that your mortgage is amortized for, so that you can actually pay less interest, right? So if you're slated to pay off your mortgage in 25 years, but you see that you're well within your budget, maybe your mortgage is 10 or even 20% of your total monthly budget, and you want to bump up your mortgage payment so you can pay it off a little bit faster, and have some more money for yourself later for retirement or anything like that. You can actually decrease the length of your amortization. So you can decrease that maybe from 25 years to 20 years, or from 20 years to 15 years, right? Whatever would work with your budget, and working with a qualified mortgage broker would definitely be able to help you kind of put that scenario in mind for you, and to give you an idea of what it would look like for you on a monthly basis. But those would be reasons why people refinance, and that they would benefit from, for those reasons. Now we'll look at the potential risks and downsides, right? Like I said, whenever something is positive, there's always something negative. With every action, there is a negative reaction, or there's a reaction, I should say. So the first risk and downside of breaking your mortgage and refinancing your mortgage would be fees, right? There's always going to be fees. So the prepayment penalties. These penalties, again, can be very expensive on a fixed rate mortgage, a lot less expensive for a variable rate mortgage. So these are some of the things you have to think about before you just go to jump into refinancing your home, right? You want to make sure you're working with a qualified mortgage professional that can tell you and help you to estimate how much the prepayment penalty would be. Because if you go into this, refinance with someone who's maybe just hungry for a commission check, you might end up with the short end of the stick, with having all your home's equity being, sucked out because you've had to pay prepayment penalties, right? They get their commission for the new mortgage that they've now been able to secure for you, but now you've maybe not earned as much as you hoped from the refinance transaction, or you even had to come out of pocket to pay fees and penalties and stuff like that that were not forecasted. So it's really important that you work with someone professional to avoid this mistake and this downside. The second thing is legal and administrative costs. Now, in every single real estate transaction across this country of Canada, you are going to pay legal costs and admin costs for every real estate transaction. Whether you are buying, whether you're selling, whether you're refinancing, it does not matter. You're going to pay legal and you're going to pay admin costs. So the first fee that you're going to think about when it comes to refinancing your property is the appraisal fee. Now, why did I list this one first? Because without an appraisal, the lender is not going to be willing to refinance the property. The lender wants to make sure that they know that your house is actually worth the amount that it's worth, so that they can actually do the math on their end and see if it would make sense financially to refinance your property, right? If appraisal fees can run you typically about $600 in Ontario. Other provinces, I'm not too sure. If you're watching this from a different province, I'm not too sure what appraisal fees might be there, but I know in Ontario, plus or minus 1600, not 1600, $600 for an appraisal. All right. Legal fees. You're going to pay a lawyer to represent you in every real estate transaction. So legal fees, our industry standard that we kind of do on our paperwork is about $2,000 for legal fees. There are certainly lawyers and firms that will charge you a lot less than that. For my personal transactions, I've paid probably $1,000, but it really depends on who you go with and the level of professionalism that you want from your legal firm, right? Or your lawyer that's representing you as well. So you have to consider that as well. So we ballpark $2,000. Lastly is admin fees. Bank admin fees can range from $300 to $500 or even $600 for a transaction like this, right? So you're going to pay admin fees. Longer mortgage term. So something to think about. Anytime you're refinancing your mortgage, the lender is typically, unless you request otherwise, the lender is going to re-amortize your mortgage term, the length of your amortization, because it will help you to qualify for the larger mortgage amount. Because remember, you're getting rid of your existing mortgage, right? So maybe you're left with 15 years amortized for your mortgage, and you've been paying your mortgage for 10 years. You've had a good amount of equity built up into it, and now you want to cash out, maybe do some investments, you want to do some other things. For you to be able to afford an increased mortgage amount, right, at 15 years amortization might be a bit challenging. So what the lender will do is give you the opportunity to re-amortize, lengthen the term of your amortization back up to 25 years so that you can qualify. Because at 15 years, that mortgage payment might be really, really high, and it will be difficult for you to qualify and to afford your monthly mortgage payment, right? So it could increase the total interest that you're paying on your mortgage overall, right? So in the short term, you could be saving money, you could be, benefiting in some way, shape, or form, right? From the lump sum of money that you're getting, you're saving money by refinancing. However, the risk involved is that you're paying a lot more interest because now you've lengthened. It's basically you've reset the amortization, and you're paying interest on for another. Yeah, you've increased it for another 10 years. So instead of actually paying for this home over 25 years, you've added another 10 years. So now technically it would be as if you've been paying interest for 35 years, right? As opposed to 25 years. So you have to think about that. And again, not necessarily a bad thing, right? Because if you're strategic, you can always, sell your property. Or if you want to continue paying it off, you can even pay down the property. There are strategies that you can use to kind of avoid this. There are also opportunities to do rental cash damming. There's a Smith maneuver. There's a lot of different avenues that you could take. That if you work with a qualified mortgage professional, now very knowledgeable, very understanding of what your current financial situation and what your goals are for the future, you can actually avoid kind of paying a lot of the interest over the longer mortgage term. But that's a potential downside and a risk, though, is paying a lot more interest. Now, the other thing is a risk of over borrowing. right? So a lot of people who were in the pandemic, again, their mortgage rate was at 1%, 2%. And if they refinance their home at that rate, they could afford it. Now, if they're in a variable rate mortgage rates increase, they can no longer afford that mortgage and they've actually over borrowed, right? So that's the risk that you can take, depending on which lender you decide to use. If you decide to go with a private mortgage or anything like that, they're not going to consider your debt thresholds. Even a B lender, right, is going to stretch out your debt limits, and so you can actually refinance at a higher debt load with a higher debt load with a B lender or subprime lender. And that can cause you some financial strain if you don't have a strategy to kind of offset paying a lot more in your mortgage for your budget, right? So if you don't have a good strategy, you don't have a good plan for the future financially, this can really cause some financial strain for you and can end you up in a position where you're forced to sell your home, right? So you have to be very careful. So these are some risks and downsides. Again, not an exhaustive list, but it definitely gives you a good picture of some things that you can expect as risks when you're looking to refinance your mortgage. So when does it make sense for you, right? If interest rates have significantly dropped and you could definitely benefit from paying less interest on your mortgage, it would be beneficial to see maybe breaking my fixed rate mortgage and the penalty being 15,000 would actually help me in the long run because I'm going to be paying less interest over the term of a new mortgage. So maybe it would make sense, right? That's something to think about. So if you can afford, a penalty of 10,000, 15,000, or what have you, and you're going to save maybe let's say 20,000 or $30,000 worth of interest over the 5-year term of a new mortgage, it might make sense for you to go ahead and do that to refinance your mortgage. If you need cash for major expenses, this is something that might be beneficial for people, right? If you want to do a home renovation, that could potentially increase the value of your home. Why not refinance your home, right? Because if you're looking to sell, if you're looking to, make it more attractive, you're looking to turn it into a rental in the future, and you want to be able to charge, a premium amount for rent, that can be something that's beneficial to you over the long term, right? If you renovate your home, so you refinance it to get some cash to pay off contractors to get your home updated and spruced up. For tuition costs for children, right? That's something that's really important. If you haven't had the opportunity to save up in an RESP or any other fund to be able to save money for your children's education, refinancing your home can be an option for you. I've seen, it's not here listed, but I have a family friend who she has owned her property for decades. I don't want to say, my age myself, but she's owned her home before I was even born. And so I know that for her children, when they all got married, she had some cash set aside for them, right, after refinancing her home, so that she could help out with their wedding costs, right? So that's another reason why some people might want to refinance their property. And the last thing that I'll talk about is for investing, right? A lot of people do this. A lot of people refinance their properties in order to invest, right? So have a lump sum of cash or have some increased cash flow every single month so they could be investing on a more consistent basis or investing in something that, investing in an asset that can really be income producing depending on how much you can get from your mortgage refinance, right? So these are some things why it would make sense for you to refinance your mortgage. If you have high interest debt to consolidate, this would definitely make sense for you in most cases. In most cases, this is going to save you a lot of money every single month. Could be even hundreds, could be even thousands, depending on the situation, right? But most people who are paying a lot of credit card debt, have student loans, car loans, I am going to give you the idea. Definitely look into consolidating your debt into a mortgage because you pay less interest. Your credit card interest is about 20%. Your student loan interest is at least 8%, right? If you're in the province of Ontario, your car loan is maybe 6%, or maybe you had a bad credit scenario where you had to just purchase a car because you had a family, you got to get around, and now you're paying 15%, 20% interest on your car loan. Refinancing that into a mortgage, paying about 4% or so, 4.5%, that's definitely going to save you a lot of money every single month, right? So that would definitely make sense for you to refinance. If you want better mortgage terms, right? I know one specific term is prepayment privileges, right? There are certain lenders who will allow you, I won't mention the name, but there are certain lenders who will only allow you to prepay your mortgage up to 15% per year. So let's say your mortgage, for easy math, let's say your mortgage is $100,000. They will allow you to put up to $15,000 per year, right? Whether you're paying it on a monthly basis, so adding it to your monthly mortgage payment, or you put a lump sum down of 15,000. They'll only allow you to put up to that amount without penalizing you, right? If you put more than 15%, they'll penalize you. Some lenders will allow you to put up to 20%. I've even seen some put 25%. So you can put up to 25% of your mortgage balance in 1 year without any penalties, depending on the lender. So if you want better terms, you can refinance your mortgage to a better lender or renegotiate better terms for yourself with your current lender so you can have terms that work for you and where you see your life headed in the future. All right, so I want us to dive into a case study now. So this case study, we're going to be looking at a client, right, that has come to us, right? Today, you're going to be sharing the mortgage license with me. We're all going to be Genus Mortgage colleagues. And so we're looking at a client case study here who's looking to refinance their mortgage. They saw a Facebook ad that was running for Genus Mortgages. And so they're interested in learning how they can benefit from refinancing their mortgage, right? So our client's name is George. So George has a current mortgage of $420,000 on his property, right? So we know that he has a balance of that amount. He would like to refinance his mortgage to consolidate his monthly debt payments. So he's currently paying $1,500 a month just in his debt payments, right? This doesn't consider all of his other living costs and even his mortgage. This is simply consumer debt, right? Debt that's not necessarily tied to anything else. It's just a credit card, it's a car loan, it's what have you. So it's $1,500 a month. George is hoping to reduce his mortgage interest rate and his monthly cash flow. So there's two different goals that George is looking to accomplish with a mortgage refinance. He's looking to, number one, lower his mortgage interest rate because he got his home during the pandemic, or during a time where interest rates were higher. And so his mortgage rate's a bit higher. And so since rates have come down, he's looking to refinance to take advantage of a lower rate. And he's also hoping to increase his monthly cash flow. So these are two things and two results that George is looking to achieve by approaching Genus Mortgages. All right. So lastly, very key, important piece of information. George's home is appraised for $700,000, right? So that's very key. Remember, I was saying earlier, without an appraisal, the lender is not even going to look at the refinance deal that I'll bring to them, right? So we know that his home would be appraised for $700,000 based on other properties in his area that are similar to his in terms of the type of home, right? So whether it's a townhome or a single home, the number of bedrooms, number of bathrooms, the size of the garage as well. All these different factors have to be very similar in terms of our comparables, right? So in the world of real estate, we'll call that comparables, right? Or comps for short. So we're looking at all George's comps for his refinance deal to see and kind of qualify unofficially that his home would be appraised for about $700,000 based on the sale of homes in his area that are similar in type to his. So when we do the math, right, George has about $280,000 of equity available in his home, right? So he's got his home is worth $700,000. He has a mortgage balance of $420,000. So we're going to take that $700,000 amount, deduct the mortgage balance because we're going to have to make sure we pay off that mortgage balance of $420,000, and what we're left with is the $280,000. Okay, I really hope that makes sense for you if you're watching this. And if this confuses you, this really took me a lot when I was doing my exam to get licensed. I really had to study well and understand the math on this. It can be confusing because it's, math is word problems. Math is a lot of people's weak point. If you have questions, I do not want you to just kind of blow through this and just think, oh, like, I don't get it. Reach out to me. Let's have a conversation. I'm willing to sit with you, to talk with you, to talk about a potential scenario. If you're a current homeowner, what would your scenario look like? Let me crunch the numbers for you. All right. Don't feel discouraged. Don't feel this, despair because you're not able to do the math on this. This is why I'm here. I'm a licensed professional that can help you to crunch the numbers and make sense of your situation for you. Okay. So in this case study, $700,000 home. His current mortgage balance is 420,000. So if we can get George, if we can get an appraisal, an official appraisal at 700,000, get a refinance, pay off his current mortgage, right? His equity would be $280,000. One key thing to note is that whenever we're going to refinance George's mortgage, just for George's home, lenders will only allow him to access up to 80% of his equity, right? Only 80, sorry, not of the equity, of the property of the home. He'll only be able to access up to 80% of the value of the home. So we're going to look at this a little bit different, right? A little bit more in depth in the next slide. But I want you to understand that. So if his home is worth $700,000, the lender will only allow him to access up to 80% of that $700,000. No lender will be willing to give him $700,000 mortgage loan on his home that appraises for $700,000. That is too much risk for the lender. If something were to happen where George is not paying his mortgage and the bank has to now sell his home to maybe get some money back, they're not going to make any money because they loaned out almost 100% of the value of the home. So they're going to only loan up to 80%. Okay. So let's look at the next slide here. So we'll kind of summarize this again. So his current home's value, his estimated home value, is at $700,000. Remember, lenders will only give him up to 80%. So 80% of 700,000 is 560,000. So we're going to look at getting a mortgage, an increasing George's mortgage to $560,000 on his current home. All right, so we're taking his current home, right? We're getting it appraised at the new appraisal amount, right? Based on the home sales in this area. And we're going to say it appraises for about $700,000, right? Based on the market. We get that appraisal for $700,000. The lender is only going to give him up to 80% of that $700 as a mortgage, right, on his home. So his current mortgage, so the lender will only give him $560,000. His current mortgage balance is $420,000, right? So whenever we're gonna get him his new mortgage, he has to make sure to pay off that old one, right? Because he can't just leave that sitting in limbo. That's a lot of money that the bank is gonna lose, right? If we don't pay that off. So we have to make sure we pay that mortgage balance back, right? So the $420,000, we pay it off. So what we're going to do is 560,000, right? His new mortgage loan minus his current mortgage loan of 420,000. The difference is $140,000. So based on this scenario with George, we could potentially earn him, right, $140,000 in equity from his home, cash in his bank account. Do you see how powerful refinancing your property can be? If you had $140,000 liquid cash today in your account, what would you be able to do? Right? What debts would you be able to pay off? What investments would you be able to get into? Right? How would this change the trajectory of your financial future if you had a lump sum of $140,000? Very, very powerful. Okay. And again, working with the right professional, working with someone who understands your situation and what your goals are, this is going to set you ahead years. Because for you to try and save $140,000 in cash is going to take you a long time. Right? Or if you have $100,000, adding $140,000 can really uptick what you already have going on. Right? So just a little summary here. So George is able to access the difference of the 80% of the home's value of 560,000. So he owes the bank 420. So again, we pay off that 420,000. with the new mortgage, and what he's left with is $140,000 cash. All right, so we'll look at George's scenario, right? Because remember, George wants to reduce his interest rate, right? Remember his two goals: wants to lower his interest rate, and he wants to increase his monthly cash flow. So we're going to look at his scenario as a licensed mortgage professional and put this together for him. All right. So again, we look at his current, we haven't refinanced his mortgage yet. We're putting it together for him, right? So he still has his current mortgage balance of $420,000. All right. So we know that we can refinance him, but we just want to put it together. So again, current mortgage balance, $420,000. His car loan is $40,000. His student loans is $50,000. His credit card debt of $10,000, bringing his grand total of debt to $520,000, right? So if we look on the right side, we have his monthly debt payments broken down, right? So every single month, he's paying about close to $2,700 every single month for his mortgage. And his current mortgage rate is at 6%, right? So he wants to lower that 6%. He pays about $500 a month for his car loan. He pays $500 a month for his student loan, and he pays $500 a month for his credit cards, right? So he's paying in total about $1,500 of consumer debt, right? Aside from his mortgage, he's paying about $1,500 every single month. So that's something that we can look at now to see how we can maybe increase his cash flow, because $1,500 is going toward debt. So what can we do, right? What can we do to help him to lower his interest rate, increase his monthly cash flow, right? Right now, he's paying about $4,041 $4,200 almost dollars every single month on his mortgage and debt payments, right? That's a lot of money, right? That's a lot of money. So let's see how we can help George achieve his goals, okay? So yeah, a little summary at the bottom. So George has a total of $100,000 in consumer debt plus the mortgage of $420,000. So he's paying about $1,500 every single month toward his debts, right? So let's go to the next slide here. So we're going to do a little before and after, right? So we're going to summarize again what his current situation is, right? So before financing, we'll look at that first column, right? The second column, sorry. So again, his mortgage is almost $2,700 a month, 6% interest rate, $40,000 car loan, $500 a month, $50,000 student loan, $500 a month, $10,000 in credit cards, $500 a month. So he's dishing out of almost $4,200 every single month. Okay. So after refinancing George, this is what his situation would look like. Okay. So we've refinanced. So I don't want to start with the mortgage payment, right? I want us to start with the debts. Notice how they're all zeroed out. Because if we refinance George, or we're able to get him refinanced with that equity payout of $140,000, we're going to knock off that debt. So he will no longer have to pay those debts anymore. They will be non-existent, right? So because we gave him the new mortgage, right, we're going to get him the new mortgage at a different rate, lower amount, increased amount, but because we've increased his mortgage, we're going to help him to pay off all of his debts, right? So I want you to notice that all those zeros, he's not having to pay his car loan, his student loans, nor his credit cards any longer. So his mortgage payment increases to $3,099 a month at a 4.5% interest rate. So that means we can help George accomplish his goal of lowering his interest rate. And number two, we'll increase his monthly cash flow. So we're able to achieve two of his goals, right? So he saves himself about $1,087 every single month after refinancing his mortgage. That is a lot of money every single month. That's a part-time job for some people, right? We're able to give George almost $1,100 back into his pocket every month, right? Now George can increase the quality of his life. He can buy better groceries. He can afford a better car. There's a lot of things that George could do with that extra $1,000 a month, right? So because he's not paying those debts, he's able to save. So not only that, but because we've paid off only $100,000 of debt, George now keeps the balance of that equity payout of 140,000, right? So because we've paid off 100,000, he still has $40,000 left to himself available, liquid cash to invest or to improve his quality of life in some way, shape, or form. Right. So that's why I'm saying that refinancing your mortgage can really be a powerful tool that can help you to get rid of debt in your life, right? And to really, really increase the quality of your life, for your family, for your financial, and hit your financial goals, right? And improve your financial future. Um, and before I want us to get into some investment strategies, right? Um, Now, these investment strategies I want to talk about because I think, refinancing your mortgage, you're always free to do what you will with your own money. But if you're going to work with me, I'm definitely going to advise you on doing the wise thing with an opportunity like this to get access to this cash, because it's not every day that you're going to come across an opportunity to get, $40,000, $50,000, $20,000, excuse me, $100,000. It's not every day. So it's really important that with this money, you are equipped to know what to do with the money once you receive it, right? I don't want you to be like a lottery winner who wins the lottery and they blow all their money just going crazy and not thinking long term, right? And you end up in the same boat that you were in before you won the money, right? Wealth is created not because of money, but wealth is created because of what you have going on between your ears, right? The mind and the knowledge, the wisdom, the understanding that you have is going to help you, determine and make the right decisions to create a life, right, of wealth and create a life of abundance for yourself and for your family, right? And so having this cash means nothing if you don't know what to do with it, right? So it's really important that you use these strategies correctly, right? And there are always a lot of options, and I'm going to give you a lot of different options here. But I wanted to preface all this by saying this, right? Because it means nothing for you to get rid of your debt to put yourself back in debt again. So, anyways, let's jump into this. You've got an extra $1,000 a month to invest, or you've got a lump sum cash of $40,000, $50,000. What should you do? So we're still talking to George, right? What should George do right now, right? With this scenario, we're able to refinance him. We bring him to a lender. He's able to save that amount of money every month. He gets a lump sum of cash. What is George's next step? If he's interested in investing in real estate, these are some options available for him. Number one, he can become a landlord. If he's always dreamed of becoming a landlord, owning properties, and dealing with the headaches of tenants, but dealing with the short-term pain for long-term gain, then this is something that he might be able to do, right? Depending on the market he's able to crack into, $40,000 can actually purchase you a property, right? And making the right moves. So what can we do? George can become a landlord and really kind of position himself, as a long-term, tenant, have long-term tenants, have short-term rental tenants. Depending on the strategy he wants to employ, we can put him with a partner of one of our realtor partners that can really help him to strategize and see how he could benefit from becoming a landlord, right? Number two is joint venture investment projects. So JV investment projects. So these are where there's an individual. So maybe you don't want the stress and headaches of dealing with tenants, but you still want to be really hands-on in the real estate industry as an investor. What you can do is look for someone who is very well versed and very experienced in the game of real estate investing. They have a really great network of professionals, and they procure real estate and grow a portfolio using other people's money. Right. So if you're looking to partner and become a partner with one of those types of individuals, you can joint venture with them, sign a contract, form a corporation, and purchase an investment property that you all will benefit from. Right. And those are usually a lot longer term payouts where you're not going to get your money back tomorrow, the year after, or 2 years after that. You usually have to wait at least 5 years or even at least 10 years to get a really good payout from your investment, right? The next thing is private lending. Private lending is extremely risky. I want to say this. Private lending is very, very risky. However, it can be very lucrative depending on how you position it and who you're able to connect with to get involved in the private lending space. excuse me, if you're able to connect with a company or a strong network, an individual with a strong network, you're able to potentially make, 10% on your money, maybe every month or every 2 months, right? Depending on who you're willing to lend out to. If you're lending out to real estate investors, flippers, they're going to give you your money back pretty soon because they don't want to incur the interest charges on the loan, right? So um, private lending can be very, very lucrative. You can earn a lot of money every month, every year, sorry, from private lending on your money. However, it must be said, it's very risky because if you do go the private lending route and the person does not pay you back, how it works is the if you decide to pursue the borrower for your money, if you're not able to get the market value for the property, it's going to be really hard for you to get your money back, right? As well as if there's multiple lenders for that borrower on that property, it depends on how, what space, what rank you are, right? In the line of the lenders. If there's 2 mortgages or 3 mortgages that this person has borrowed for the property, if you're number 3, it'd be very tough for you to get your money if you're to pursue that person, right? So that's something to think about. Again, always talking about the risks and downsides. However, private lending, again, can be very lucrative. And the last thing and the least risk involved strategy would be investing in a real estate investment trust, right? So these are called REITs for short. You can access these on Wealthsimple. You can access these through your bank if you have a brokerage account and you have access to mutual funds. REITs are very popular. They're very, very beneficial for those who want to invest in real estate without the headaches of dealing with a lot of risk. And essentially what REITs are, they're companies, corporations that are formed that do the same thing that a joint venture individual does or company does, but at a much larger scale. And they're providing a lot more security and a lot more surety to your investment. Now, again, anytime you're investing, there's nothing that's 100% guaranteed. So I don't even want you to think that REITs, there's no risk. There is definitely still risk for you to lose your money, depending on if the company's not performing well, if it's not being managed well, if real estate market is down for the year or for a couple of years, there's always risk. However, REITs are going to be your most secure out of these methods of real estate investment. Yeah. All right, so let's jump into some other investment strategies, right? So if you're not interested in real estate, fair. Not everyone is interested, sorry, in real estate. Real estate can be a tricky game. It can be complicated for a lot of people, and some people just are not interested, right? And that's perfectly fine. So some other investment strategies and options for you would be stocks, right? Stocks are a great option for most people, right? Everyone should be invested in some stocks, I believe. Stocks are very high volatility, so you have to have a good risk tolerance. Stocks are really great. There are different types of stocks, of course, different payouts, different stability to companies. But stocks can be a really great way to grow your wealth if you have a lump sum of cash, trading stocks, or if you have some money every single month that you can put into a brokerage account that can help you to invest in stocks. It can be a really great strategy. Mutual funds. Mutual funds are a great option as well. So again, like I was saying, you will find some REITs are formed and structured as a mutual fund, or they're involved in mutual fund. Mutual funds are essentially a conglomerate of companies that are placed into one bucket that you can put your money into, right? So when you're investing in a mutual fund, you're not investing in one company like a stock, right? You're rather investing in multiple companies, right? It could be even 100 companies, hundreds of companies in mutual funds that you're investing in. So your money that you're investing is not just in one company, but it's based on the success of all the group of those companies, right? And someone is managing that fund. They're investing the bulk of that fund in different companies. They're moving the money around and they're trading it, trying to make sure they get the best returns for that mutual fund, right? So it's a lot less risky than a stock because you're able to diversify your risk. And so, you're not as exposed to losses of particular companies. The reason why I put volatility varies is because there are different types of mutual funds. So although mutual funds are typically not as risky as stocks, some of them can be as risky as stocks, just simply because of the structure of how it is structured, the industry that it's focused on. Right, right now, the oil industry, the energy industry, sorry, is typically performs pretty well. But there can be some funds within uh, that industry, the energy industry, that maybe don't perform well, right? They're not managed well. There are some in the tech industry, right? Tech industry is booming right now. And I think it can be a really good thing to invest in. However, it's not always going to be up and down, right? The one principle that I like to bring to investing, and this might help you as well if you're not well versed with investing, but think about it this way: any investment that's good, that's promising to give you a great reward, will also come with a lot of risk as well, right? That's typically how you think about investing, and anything in life, really. However, it doesn't mean that you shouldn't invest, right? Because there are always ways to mitigate your risks whenever you're investing. Mutual funds is a great, great way to mitigate your risks if you are a little bit more risk averse and you don't have as high risk tolerance, right? So volatility varies because there are different funds with different risk profiles, right? So some of them are more aggressive, some of them are more conservative. And so depending on your investment goals, depending on what you're trying to achieve, you're going to be you're going to be it's going to depend on, it's going to lead you to know which mutual fund to invest in. Bonds, right? Investing in bonds. Essentially, what a government bond is, what a bond is, sorry, it's a government loan. It's a loan. So I was going to say government loan, but it's not a government loan. It's rather a loan that you give to the government, right? So a bond is an agreement where you say, I'm going to loan you, $100,000 for 5 years, and you're going to pay me back an interest of 3%, right? That is what a government bond is. So essentially, you're earning interest on money that you're loaning to the government. Uh, Pardon me, government bonds are typically very low volatility because they are assured by the government. So it's very unlikely that a government will not be able to pay you back for the loan that you give them. And so government bonds are typically seen as very, very secure investments. Um, a lot of rich people who are maybe in their older years, who have maybe retired, who have been able to grow large investment portfolios, they are ones that definitely invest in bonds because they don't want to see their money diminish, but they're still looking for it to grow, right? And they don't want to touch the bulk, the nest egg they call it, of their money, but they're looking to earn interest and live off the interest of their nest egg, right? So that's a government bond would be a great option for that. Government bonds are not good for growth. If you're looking to really grow your money at a fast pace, a government bond is not going to do that for you. It's going to be very slow in growing your money. This is typically for people that have already grown their money. The last but not least, very controversial, but I think there is definitely something worth looking into with this one, but cryptocurrency. Cryptocurrency has been, an underground thing for many, many years now. I've been interested in it for many years personally myself. I am invested in cryptocurrency. I'm not going to tell you which ones I'm invested in, and I'm not going to tell you to invest in cryptocurrency at all. To be frank, I'm not telling you to invest any of your money in any of these investment vehicles at all, because I'm not an investment advisor. And so please don't leave this webinar saying that Omar told you to invest in stocks or mutual funds or bonds or cryptocurrency or anything like that, or even in real estate. I'm encouraging you to look into these things, and I'm definitely open to having conversations about it on a professional level. Particularly with the real estate investment slide that I was talking about. But for these other investment strategies, there are professionals that I can connect you with that would have a lot more knowledge, and they're licensed professionals that can help you to invest your money wisely and can help you achieve your financial goals. But cryptocurrency is something I think is definitely worth looking into. Um, uh, I won't tell you again which one to invest in, but there's been some really, really, really great growth with cryptocurrency. And there's a lot of changes happening in our world economies right now, right? Many of the economies around the world, the US, Canada, in the Middle East, in Asia, there's a lot of countries that are adopting cryptocurrencies. And it's looking like some of them might be pretty promising for the future. Now, of course, cryptocurrency is extremely volatile. The prices go up much, or sorry, the prices go down much more than they're up. There are times where if you can get in at the right time, where you're going to see some really massive growth on your money. However, that massive growth typically doesn't last very long with some coins. And so you're going to have to be very careful and know what you're doing with cryptocurrency. So it's something that you really have to learn and dig into and invest your time in. However, if you're willing to do that work, you can really see some great benefits. And lastly, I want to say enjoy your life, right? As much as I'm a proponent of making wise decisions with your money, making sure that you're investing and securing your future, I also believe that you have to live a balanced life. If I have a lump sum of $40,000 cash, I'm definitely going to look how I can invest majority of that money, but a certain percentage of it is going towards some enjoyment, right? If you have some money, book a family vacation, book a vacation for yourself, go and travel, see somewhere in the world that you haven't seen before, right? Go and enjoy your life, renovate your home, right? It's if you're living in a home right now where you're not super happy with where you live, there's certain things that are bothering you, go ahead and look for some quotes and get some contractors in your home to renovate your home. Purchase a new car, right? Within reason, right? Purchasing a new car can definitely set you back some years if you make the wrong move, if you go too expensive. But if you're driving, something right now that's a little bit of a rust bucket, like I like to call it, go ahead and purchase a new car if you have some money that you can definitely use toward that. If you got $40,000, $50,000, you can put a down payment on a new car and enjoy your life, right? Treat your significant other. If there's something that you've wanted to do for them, place you've wanted to bring them, a dinner, a restaurant you wanted to take them, a piece of jewelry or something like that, go ahead and then treat your significant other. You work hard, so I believe you have to play hard as well. Because in this life, especially in North America, you are always pouring out, you're always working, you're always striving, you're always grinding. And so it's really important that you take time to pour back into yourself, right? To be frank, even if you don't have the money to do so, find a way to take some rest, whether it's one day a week to just pour back into yourself, whether it's, however that looks like for you. And so that's it. That's the webinar. That's my presentation. I appreciate you for watching to the end. I appreciate you, trusting me to provide you with the knowledge and information that can really, really change the trajectory of your financial future. That is my aim. That is my goal. That's why I got licensed as a mortgage professional, to be able to help people with the information they would need to really change their lives. And so please feel free to ask any questions. Send me an email. My information is there at the bottom. You can give me a text or call me. I'm always willing to discuss with clients about questions they might have, or if they're looking for information, or if you're looking to run a scenario by me. Would refinancing make sense for you? Purchasing, even if you're not, again, even if you're not a homeowner, if you're looking to purchase a home, it would make sense for you to maybe purchase a home that you can be able to refinance in the near future, right? That you can get some appreciation in your property, right? So that you can refinance and take a lump sum of cash out. This can affect which home you buy as your first property. So working with the right professional, again, is going to be able to help you to strategize this and give you the right information so that you can make the right moves for your future. All right. So give me a call, give me a text. That's my phone number. Shoot me an email. You can also find me on social media. On every single social media platform, I am there. I'm on Facebook, I'm on Instagram, I'm on TikTok. I'm also on LinkedIn. You can find me on LinkedIn by my name. But on the other socials, you can find me with Genus Mortgages. Okay. Thank you so much again for taking the time to watch this webinar. I really hope that you were able to pull something from this. Even if you kind of knew something about refinancing, I hope that you were able to get a little tidbit or nugget that gave you some more knowledge and help you to round off the information you have around real estate, around and how that can help your financial future. All right. Again, feel free. Comments are also welcome. Feedback is welcome. Shoot me an email, send me a text, give me a call, and I'll be more than happy to entertain a conversation with you. All right. So until I hear from you, take care and all the best in your journey.